Welcome and thanks for joining this short guide comparing ESOPs and traditional stock options. The slide visually stacks the two approaches so you can see their structural differences at a glance. Over the next few minutes, we'll walk through alignment, taxes, risk, liquidity, and practical choices so leaders can match incentives to strategy with clarity. This slide contrasts long-term alignment with short-term incentives, showing how ESOPs act like retirement vehicles that tie employee fortunes to sustained company growth, while stock options are designed to reward shorter-term performance and liquidity events. Think of ESOPs as building a nest egg over decades and options as a way to capture rapid price spikes at exit. Here we focus on tax timing and implications. ESOP contributions are typically tax-deductible for the company, and taxation often occurs at distribution, which can mean capital gains treatment for employees, while traditional stock options trigger ordinary income tax on the discount at exercise, and then capital gains on later appreciation. The key point is front-end company deductions versus immediate income taxation for options. This slide compares investment and market risk. ESOP participants generally invest no personal cash and face limited exposure tied to valuation changes, making ESOPs lower personal financial risk, whereas option holders must pay the strike price to realize upside and therefore risk losing their purchase cost if the market price stays below exercise cost. In short, ESOPs reduce capital risk. Options increase leverage. Liquidity and exit mechanisms differ fundamentally. The graphic shows ESOPs providing internal liquidity through a trust that can repurchase shares on a defined schedule, offering predictable outcomes at departure, while traditional options rely on external events like public markets or acquisitions, creating timing, uncertainty, and dependence on market conditions to realize value. This slide helps match instrument to company stage. Mature, cash flow, positive firms often favor ESOPs to institutionalize employee ownership, support succession planning, and deliver long-term stability, while startups frequently choose stock options for flexibility, lower setup cost, and the ability to attract talent by betting on rapid valuation growth and near-term exit dynamics. The launch and ongoing cost comparison highlights that ESOPs require ERISA compliance, independent valuations, a dedicated trust and ongoing administration, which drives higher upfront and recurring costs, whereas stock options usually need board approval, standard agreements, and captable tracking, making them quicker and far less expensive to implement for early-stage companies. When choosing a path, consider priorities. Pick ESOPs if you value tax-efficient retirement benefits, cultural ownership, and gradual succession. Choose stock options if your focus is motivating teams toward near-term exits, conserving cash, and keeping the equity structure simple. The right choice depends on whether you're optimizing long-term stewardship or short-term growth incentives. This final slide recaps the table. ESOPs offer cost-free employee ownership funded by the company, long-term value alignment, moderate tax-advantaged risk, and a stewardship focus, while traditional options create leveraged upside, tie value to liquidity events, carry higher tax complexity, and serve to incentivize short-term performance. Align the instrument with strategic intent and company stage for best results.